gotta be flipping my flapjacks. Warren Buffett, the big Buffett, just bought into United Health stock. We're going to speak about United Health stock at the beginning of this video. This has been one of the most hated stocks in the entire stock market this year. Just an absolutely horrible performer, like of big dog companies. Like, it's probably one of the worst performers, if not the worst performer this year. The stock's up 9% after hours. David Tepper, another legendary investor from my understanding, also bought in. So I want to talk about UNH at the beginning of this video. Do I think it's an opportunity? Do I think it's not, in regards to this news that came out here after hours? Okay, hims and hers, this stock continues to get hit, down another 2.5% today, down another 4% plus after hours. So we'll speak about what's going on with hims, kind of my perspective in regards to the whole situation there. Okay, so we'll talk a little healthcare related stocks. You're not going to hear me talk much ever about healthcare related stocks, but we got a couple to speak about in this one. Okay, Trade Desk, this stock continues to get hammered, down another 6.6% here today. This is another one of the worst performing stocks you can possibly find out there. I mean, it's just been a complete disaster for this stock this year. I mean, you went into this year, stock was around 120, and it's a $50 stock here today. Last time I checked, that's what, a 60% downfall or so. So we'll talk about Trade Desk. What's going on there? Is this an opportunity for that particular stock? And then last thing we'll get up into in this video here today is Tom Lee. Tom Lee went on CNBC, everybody's favorite bull, just a bit ago. So looking forward to reacting to that video, sharing my opinions and perspectives on this. One thing all I need from you guys, please hit the like button. That's all I need from you. If you could just hit that thumbs up button, make it glow, you are my hero, okay? I hope you enjoy all the videos I provide for you guys. And listen, everybody on the main channel, don't get too spoiled. I'm posting videos almost every day on the channel this week, and the reason being is my reaction channel is not letting me post on there right now, and I'm trying to get in touch with YouTube. If you ever need to have support on YouTube, it's not a good experience. So I'm trying to get that channel back up and rolling. But for this week, I'm having to upload my normal videos on the channel here and reaction videos as well. So usually, we do this separately. And so, hey, I want to give you guys something free here today. Some of you guys might have gotten this in the past. Some of you might not have. I shouted it out about a month ago, back in July. But I'm going to put it as a pinned comment down there today. If you want a free checklist to basically go through, this is something I look at before I go to buy a stock. I think that can help you out tremendously. I can send over that PDF. Just enter in your name, your email. If you want to receive it via text, can send it over via text. It's absolutely free for access to that. I think it's going to help a lot of you guys out there. Okay, that will be the pinned comment down there. Alrighty, first up here, United Health, UNH. So listen, the big Buffett bought, right? From my understanding, David Tepper also bought UNH. That's really bullish for UNH in the respect of, I mean, anytime Warren Buffett buys a stock, usually it ends up pretty well. He does not bat 100%. No one in this game ever bats 100%. David Tepper, seen as one of the best investors ever, legendary investor, right? Legendary hedge fund manager. David Tepper, people will look at David Tepper and they would say, like, if he's getting involved in something, it's probably going to go very well, right? But he doesn't bat 100%, as no one does. And additionally, from my understanding, Michael Burry is playing UNH as well through some different avenues. Okay, so here's the deal. You got a lot of big dogs in UNH. That could put a short-term bottom on this stock, right? Given all those big dogs being invested, people are going to look at those and say, these guys are going to hold it likely for at least a few quarters, if not years. Buffett's case, probably years, right? And they look at that as good. No, my thing in regards to UNH is, yeah, this is going to benefit the stock price in the short term, no doubt, but this does not guarantee the long-term results of UNH. I think that's important. Everybody understands this when it comes to stock. Like, UNH is a whole situation. We know the government's going after companies left and right. They're making backdoor deals with. It's a weird situation right now in regards to government, right? And we do know the government debt is completely out of control. We do know that, right? We do know United Health makes an absolute fortune of money, right? Some would say they make fortunes of money from the government in certain ways, right? Through government programs, things like that. So I think UNH is going to be a mess for years. With that being said, that doesn't mean there can't be money to be made in this stock over the next few years, right? Some people are going to trade it. Like somebody like Buffett. Buffett's probably buying because he probably wants to own this for the next, 10, 20 years. Some of these other guys like David Tepper could be out of, like, let's say the stock goes 350, like I wouldn't be surprised if David Tepper got out, right? Michael Burry in his play, like, those guys might do something shorter term with UNH. Buffett's likely in this for the long haul, right? But this is going to be a messy situation. It reminds me a lot of Boeing. Boeing's been a mess now for like 7 years. I don't know if United Health would be that messy for that long, but I think it's going to be a mess for a while. I don't see this being cleaned up fast, and it's just going to be problematic. But with that being said, it doesn't mean you can't make money in the stock. That's the most important thing I want to kind of stress here. Does it interest me? Absolutely not. Absolutely not. It might go 350, it might go 400, it might go 500 in the short term. Like, who knows? But I'm not interested in being in this company long term. And I don't do short term, like, I'm going to buy the stock because Buffett's buying, so it might go up over the next, 3 weeks. Like, if other people want to do that, that's fine. I focus on what I focus on, and it goes pretty damn well. So we focus on that, where the big money's at. I'm, the rest of that speculating on, well, it might go up for the next few weeks because Buffett bought and David Tepper bought. I'm not playing that game. And I don't want to be in that company long term, just given the mess that it's going to be there. And there's just a lot better opportunities, honestly, in the market that will significantly outperform over the next 5-10 years, in my personal opinion, right? Some people would look at HIM stock and they would say HIM stock is a great stock that will outperform UNH, right? So this stock continues to get hit. It just seems like, it kind of can't get out of its way here in the short term. The stocks have been an absolute roller coaster ride this year. You look at the stock, it's mid-20s to enter the year. Shortly after that, it's $68. Shortly after that, it's $25. Shortly after that, it's $64. Then it's down to $41. Then it's up to $66. Now it's down to $45 after hours. It's all over the place. Okay, here's a deal in regards to HIMS. There's two big components of this. The first is supposedly FTC looking into HIMS, their practices, blah, blah, blah. Like, that's been something that I believe has even plagued the company going back to 2024. So, that just is what it is. Like, are they going to find, HIMS did anything wrong? Who knows? Like, maybe not. You flip a coin in regards to that matter, right? Like, if they're going to find they did anything illegal or something wrong. Okay, let's say they did do something wrong, then HIMS is probably going to get a fine. Could be tens of millions of dollars, could be $100 million, whatever. HIMS could probably weather that. Like, that's just the cost of doing business. Like, that is what it is, right? To me, actually, the more a little troubling thing was actually this. This came out actually on Tuesday. I believe it was after the bell, but I'm not 100% sure in regards to when this news hit. But HIMS shares traded lower following the telehealth firm's CEO, Andrew, disclosed the sale of more than $33 million worth of company stock. This transaction comes after the weight loss drug maker, which markets cheaper compounded versions of Novo Nordisk popular weight loss medicine Wegovy, witnessed a nearly twofold rise in value in a year. According to SEC filing, the CEO sold 660,000 shares of HIMS stock last week for an average price of $50.58. The sales conducted over a series of transactions on Thursday had a total value of $33.4 million and reduced the CEO's stake by about 7%. Meanwhile, the chief medical officer of the company sold 60,000 shares of HIMS, shares worth nearly $3.2 million. A day earlier, its chief commercial officer had parted ways with 26.6 million of the company's shares, worth roughly $1.8 million. That's one of those things. It's, it would be, if HIMS didn't have all these kind of situations around it, would be no problem. Like if they didn't have a potential, look in by the FTC or whatever's going on in regards to that matter, right? Which we're still trying to figure out details in regards to that. If it didn't have to deal with, the whole, can they sell this compounded thing or not? Like, I think the sale wouldn't be that big of a deal. But since they have all these question marks and potentially dark clouds here, and the stock's been a complete roller coaster ride this year, I think that's why people are looking at the sales and saying, what's going on here? Like, are you guys getting out because it's bad? You're not going to be able to sell certain products that are very popular and big money makers for HIMS. That's the questions people are going to ask, right? And we don't know the answers to that. No one knows the answers to that. Like, why does the CEO sell $33 million of stock? Could be many reasons. Maybe he wants to go buy a big mansion. Maybe he wants to diversify his wealth a little bit. Maybe there's something going wrong with the company and he's like, crap, I better get out of some shares now because we're going right back to the 20s. There could be a million different things going on in regards to that. So to just, assume it's one thing or another, that's difficult because there's a lot of different reasons somebody sells stock, right? So maybe he wants to buy a fleet of Ferraris, right? Yeah, I don't know. Why is he selling $33 million worth of stock? Now, in regards to valuations of these companies, HIMS obviously comes with the big valuation, right? Crazy, big premium here. Look at the forward P's, likely 70s. The 2-year forward P even is close to 40. But HIMS is supposed to have great double-digit growth for all the way throughout into the 2030s, supposedly, right? So if that's the case, then a 2-year forward P under 40, is HIMS a decent buy? If HIMS is truly at a 2-year forward P of under 40 right now, okay? And let's say they are able to grow revenues double digits a year all the way into the 2030s, then yes, HIMS would be a buy today. Now there's question marks about that, big question marks, right? And that's fair, and we've got a lot that needs to be answered in regards to HIMS over the next, I would say, 2 quarters here. Now, UNH, you look at that one, and it looks like the best steel deal of the century, right? You look at the 2-year forward P, supposedly based upon what analysts are expecting here, forward P under 10, 8. Whenever you see under 10, you got to get suspicious. There's something fishy going on, right? And for UNH, everybody's expecting this massive bounce back in profitability and all those sorts of things, right? I just don't trust it. I don't trust it. I think there's going to be a lot of changes made to their business model that are going to be negative, likely, right? And I think if there's a big short-term pop in the short term, I think there's going to be a lot of people that are kind of trading the stock, just looking to get it in and out, make some quick money here. And I just feel like the government's going to really crack down on them. And so for that reason, I just don't trust UNH at all, right? Once again, I wouldn't be surprised if the stock goes 300, 350, something like that, 400 even in the short term. But that one, I just don't trust it. Trade Desk, next one up here. Trade Desk all the way down to $50, down another 6.6%. It's an intriguing company, very intriguing company. A large company now in the advertising space, and really helps companies, basically buy advertising space on the internet, digital media in general, right? Other places as well. And they're phenomenal for being able to use data to hopefully make you make a lot more money. They have a new product that's come to market recently that's supposed to help TTD make a bunch more money and their advertisers make a bunch more money as well, right? Which would be beneficial because no different than Meta. How does Meta make so much money? Meta has the ability to run ads to massive amounts of people, and they have all this data, so hopefully they can get you the best ROI possible, right? Through Facebook and Instagram ads. And so TTD can do this all over the internet, all these different services, things like that, okay? Now, in regards to TTD, here's a deal. This came out today. Walmart amends ad tech agreement with Trade Desk, which might benefit Amazon. Ad tech firm Trade Desk, TTD, could be at risk of losing one of its most valuable clients, Walmart. TTD shares were down. According to the report by The Information, citing sources, the retail giant last year negotiated its agreement with Trade Desk and now has the option to use ad buying platforms of other firms. Under the previous agreement, which lasted for 4 years, Trade Desk was the exclusive technology provider to advertisers buying spots on the web using Walmart shopper data for targeting. The report said the move might benefit direct rival Amazon, which has recently ramped up its efforts to handle the sale of ads across the web and has been offering advertisers incentives to woo them away from Trade Desk, right? And so this is once again, Trade Desk and Amazon are going right at each other now, and that's the tough thing with Trade Desk is oh boy, I don't want to fight Amazon. That's a tough fight, right? Sources told tech news outlet that Trade Desk's high fees frustrated Walmart, which led them to renegotiate the partnership. Okay. According to the sources, Trade Desk charges Walmart advertisers in double digits to use the technology. Now, here's where it gets scary if you're a Trade Desk shareholder. In comparison, Amazon charges advertisers only 1%, which was recently brought down from 5 and 7%. What? That's insane. If this is accurate, that's insane. You got the Trade Desk charging double digits, and you got Amazon saying we'll do 1%. That's the famous Jeff Bezos quote right there. Your margin is our opportunity, right? Like that's what? That's ridiculous. A Trade Desk employee told the Info that Walmart jealously guards its shopping data to prevent it from falling into Amazon's hands. That makes sense. Like if I was Walmart, I wouldn't want Amazon to have my data. Like that's just not ideal because Amazon is a direct competitor on the e-commerce side, right? The employee said Trade Desk has built a separate version of its technology for Walmart on Microsoft Azure. Albeit, a large portion of its business runs on Amazon Web Services. Another person familiar with Walmart's thinking said the retailer could also potentially acquire an ad buying platform or possibly build its own ad buying platform from scratch. So this is a fascinating matter. You know, in regards to what does it mean to Amazon, I wouldn't get too excited about it from the Amazon perspective. As an Amazon shareholder, is a major position for me. Like, I'm just like, okay, like if they're going to use Amazon for a bunch of this, like great. But at the same time, Amazon, the business is so big, it's not like this is going to massively change numbers or something for Amazon. Like the numbers are too big at Amazon now at this point in time, right? But if you're a Trade Desk shareholder, like this is something that's got to freak you out because if Walmart's going to start using Amazon, right, or maybe do some in-house stuff, it's going to take business away from the Trade Desk, which is going to hurt future years' growth rates. We're talking 2026, 2027, 2028. So when you run your projections and your numbers on 1000xstocks.com, like maybe the growth rates aren't quite there the way you thought they were there, right? And that's something you got to consider here in regards to the Trade Desk, right? Now, you look at the charts feature on 1000x Trade Desk. I mean, it's phenomenal. Like the growth has been amazing, right? It's expected to continue to be amazing, but we don't know what happens with this whole situation. The margins look very good. Gross margins, 80%-ish range, right? Net margins have continued to kind of pick up from net margins back here at, the negatives to then 4% positive. Look at the latest quarter, 12%. The Q4, in this sort of business, net margins are always going to be the highest end. Net margins in Q4 came in at 24.5%, which is incredible for a business like this at the stage they're at, right? The earnings per share is supposed to take off like a rocket ship over the next few years, right? And the thing that's a little scary here is if they do have to really respond to the Amazon competitive threat, right? Then what's going to happen is Trade Desk is likely going to have to do what? They're going to have to lower the percentage they charge companies to compete directly head on with Amazon, which then would hurt margins. So if the Trade Desk might have some hard decisions to make, whether they want to maintain margin and have revenue potentially falter, or go after revenue growth, go after market share, and then potentially have margins hurt for the next few years. So it's a serious matter in regards to Trade Desk. And so the Trade Desk is a very interesting stock, but I think this is a very serious matter for the company. This is not something that's impossible for them to manage through, but it's a serious, real deal Holyfield. Like you've got Amazon trying to way undercut you. And especially if you're anything CPG related, I think that's a real strength for Amazon. So I don't know, man. Like I think the Trade Desk is like a really interesting stock to me, but there's definitely risks that come along with this. By the way, there's some new features on 1000xstocks.com. We have current assets and current liabilities, and now we have our cash, marketable securities, and debt feature as well. We just got that up in the last 24 hours. So 1000x members, I hope you guys enjoy that, baby. For everybody that belongs to 1000xstocks.com and got your membership card, once you join us on 1000xstocks.com, we give you your Steel membership card in the mail. You put that baby in your wallet and you're epic. Alrighty, Tom Lee looks like he had a long night.
Chairman, he's here with us at Post Nights. Good to see you.
Great to see you, Scott.
So how about that question? I mean, it's on a couple of fronts. Like we came in to this week, which you said was going to be the start of a pretty good rally, which it kind of looked like it was. Now what?
I think that the arguments and elements for a rally to continue are in place, because even today, with the hot PPI print, the stock market is basically flat. So we had a down open. I think investors bought that dip. Part of it is I don't think that the PPI is sending a message that inflation's soaring. There are some things to sort of cut out of that number.
Sure, I agree, and people have said that throughout much of the day, but it seems to have changed the conversation, if nothing else, about the amount of rate cut we might get in September. Is that fair?
Yes, it's very fair. That is correct. But if as we think about the rest of this year and next year, I think that the thing that's the worst case for investors is Fed hiking. That the Fed does nothing between now and year end, I think some would actually argue that's half full because the economy can handle these higher rates. But if the Fed does 25 or 50 between now and year end, really to normalize real interest rates, that's actually positive for stocks. So I think unless this was going to bring in the odds of a hike, I think that's why markets had a muted reaction.
Well, what if they don't do anything? I mean, Steve Leisman, who's going to join us in a minute, made the argument earlier today that this changes the conversation from, 25 or 50 to 25 or nothing. What happens if we go on the side of nothing? Can this market stand up under that?
Yes. I mean, because number one, and I'm sure Steve's going to talk about this, that the economy doesn't seem to be suffering under the weight of these current interest rates, even though the Fed is much higher than the rest of the world on policy rates. And the second part of that is, of course, that if the Fed does 25, it's still a dovish move.
Well, it could be a hawkish cut.
I mean, to be fair, to push back against Tom Lee here, right? There's some pockets of the economy that have been severely hurt by interest rates being this high. I mean, some that come to mind would be housing, autos, things like furniture, right? Anything you got to buy on loan, those pockets have definitely been hurt. And you could even look to areas like, why did Cava's comp restaurant sales go from 20+% to 2% in a matter of a few quarters? Why did Chipotle just report negative comps? Like the last time Chipotle reported negative comps, like we got to go back to probably, peak Rona, or we got to go back to when they had the E. coli issue. Like that's the last time I could remember Chipotle having negative comps. Sweet Green just reported like a negative 7.2% comp. And those are pretty disastrous. So, I mean, I think we got to look bigger. We got to look further than just the biggest, strongest companies in the world and say, well, the biggest, strongest companies are putting up great numbers. Those companies put up great numbers regardless. They're special for a reason. They're $1 trillion plus market caps for a reason, right? And it's not by accident. They're the most special companies in the entire world. And they put up the numbers regardless, but there's a lot of other companies that are not doing so well in this environment, right? And in terms of the higher net worth category, let's say the top 10, 20% of wealthy in the United States, right? They're doing better than ever. Crypto, Bitcoin just hit an all-time high last night. The stock market's around all-time highs. You're getting so much free money if you have money in the bank or savings accounts, treasuries, things like that. Way more money than you would have had at any point really in the past 15 to 20 years, right? Past year or two has been a great place to park money in high-yield savings accounts, treasuries. So you're getting just literally basically free money given to you like constantly, collecting 3, 4, 5% on that money, right? And so I mean, those are all factors to weigh in. And so if you're higher income, if you got more money behind you, it's the best time ever. But I think there's a lot, if you go beneath that, there's a lot of weakness, right? So, it's just something to kind of keep in mind.
And Leisman's thrown out that too, right? If they cut 25 and leave us with the feeling like, all right, you got your little lollipop here, everybody, and now we're going to wait and see.
Yeah. I think the market reaction, of course, is really how people are positioned. And we at Fundstrat, we're finding a lot of investors are positioned as if we're going to see a pickup in inflation. So to them, they were expecting a really hot PPI number, thought this was going to start a decline in stocks. And that's why I think markets didn't fall as much, because I think many people have been positioned for a sort of a hot set of PPI numbers.
So Steve Leisman, I'll just bring him in now. I mean, I can only mention him so many times without actually bringing him into the conversation. He's our senior economics correspondent. I like how you framed everything up today of how the narrative has changed. We continue to hear from Fed speakers too, including one that you spoke with earlier on our air, Musalem. Barkin also speaking within the last hour. What are we learning about what this print today really means that investors need to hang on the most, you think?
Well, Scott, there's just a split out there. The market is kind of hell-bent on the freight train of a September rate cut, and the Fed is simply not, certainly not a majority of speakers so far, Muslim was right down the middle. The PPI rising 0.9 for the fastest gain since the pandemic. Take out food and energy and trade, and it's still pretty strong 0.6. JP Morgan writing the fact that there is upward pressure across all recent inflation reports. Basically, it's going to give Fed officials some pause, is what they say. And then Muslim sounding like one of those guys who's saying, look, I'm in the pause camp here. So it's a big deal. Scott, I want to just show you real quickly the 2-year note. Take a look at the 2-year, and you can see the push me, pull you, the tug of war going on with what's happening in the market. You see the 2-year, it declined after that inflation CPI report. Now it's back up here. Now take a look at probabilities. You can see what's happened. First of all, the 50 cut is out. And that 93 there is 93, not because there's 7 percentage points as there was yesterday to 50. There's 7 or so in the Fed pausing. October's almost gone, and so really we have one rate cut only fully priced in for this year. That's sort of the hawkish cut trade right now, that maybe not in October and better probably not in December. That's where we're at right now when it comes to Scott, the Fed funds trade and how they're all reacting to this. I think zero or no cut is a possibility for September, but it's all going to hinge on that September data of inflation and jobs.
Yeah. Hang with us as we go back to Tom. You made the argument that this market was not just going to start this next leg of the rally this week, but it could potentially be a sizable one.
Yes.
That I think you told me we could go 6,600, if not higher, this month.
Yeah.
And this doesn't change that at all?
No, it doesn't. Last week we said the breakaway move would be S&P 65, 6,600. So I think that's still intact. I don't think that one data point is enough to change a thesis around the trajectory of inflation. And our base case remains that this is...
So if you want to know when will the market actually get legitimately scared of inflation data, and it would actually cause, let's call it a lot of fear and panic in the market, that is if CPI and PPI went over 4%. If you witness CPI and PPI go over 4%, that would get people scared, because then what would happen is rate cuts would be off the table, and then people would start talking about rate hikes again. Market would be in total freak out. So if you start to approach closer and closer to 4, you got an issue. If you go over 4, you're going to get a lot of panic in the market. So just understand that. But the question is, do we go there?
It's going to be ultimately viewed as transitory by the market.
But we have this tension that exists. Labor market looks like it's weakening, and now the inflation market looks like it's at best just kind of staying where it is, if not getting a little bit more sticky. I mean, that is a real tension that the Fed has to deal with and may ultimately have to make a decision on one side or the other. We think we know which way they'd lean, but we're not entirely clear. I'm not sure the market is either.
Yeah. Fair. Well, I guess this is the challenge for the Fed, because they're having to make a decision where there's no equilibrium, right? Because the market's tension around whether there's weakness and deviation from the job side versus inflation, it is really the Fed trying to manage expectations and keeping inflation expectations anchored. So a lot of data between now and the next meeting may not be inflation related, but it's really how the market is perceiving these inflation prints. And if we shift towards viewing it as transitory, it makes it easier for the Fed to move forward.
Steve, you have Goolsbee tomorrow morning, don't you? I can almost assume that we know what he's going to say, because he's been non-committal in everything leading up to this interview tomorrow, right?
Yeah, he's one of the ones who has already said that he's not convinced it's a one-time price increase. But I do want to echo something here from the Kansas City Fed. He'll be our host next week in Jackson Hole. He said specifically that he looks around and he goes, hey, I don't see that we're so tight. He looks at the stock market, looks at the bond market. Which parts of the economy would you look at and say, okay, we could be doing a lot better here? Tom also said something that I want to make more confusing and more technical than Tom said it, which is that there's stuff happening on the equilibrium on both sides of the Fed's mandate. You tell me what the right equilibrium rate is for the employment market, given what's happening with immigration and deportation. Then tell me what the right equilibrium is for inflation, given what's happening with tariffs. Both of these things are in constant flux every day, with a tweet from the president, other things going on, trying to figure it out. That's a reason I think some Fed officials would say, hey, I'm waiting to figure out what's going on here before I do anything.
I mean, with all due respect to President Schmid, and I still want you to get a good room assignment in Jackson Hole, Steve. I mean, the housing market is horrible. If he wants to look at one really important place that maybe carries a lot more weight than other areas,
True.
It's terrible. And cutting rates, many believe, would help at least give a little bit of medicine to that.
Yeah, I'm not sure, Scott, that cutting interest rates wouldn't mean that the money you save on the interest rate wouldn't go right into the asking price for the home. So that's not clear to me that it's an interest rate problem as much as it's a supply problem. So I agree that lower interest rates would help some people into the home, especially the hardest hit out there, the first-time home buyers that have to struggle and stretch to get into a home. I agree with that. But right now, when you have a limited supply, what would happen was a rate cut would end up increasing the price of the home, not necessarily in a saving for the buyer. And by the way, if that's the problem, and I'm going to talk heresy here, nothing stops the Treasury, the administration, or the Congress from providing further assistance to the mortgage market if that's what they want to do. Treasury can go out and buy mortgages and drive down the rate if they think that's a problem. The Fed's trying to make a single interest rate for the entire economy. And right now, the way they see it, they're a little bit above neutral, a little bit restrictive, not 150 the way Scott Bessent says. And we just had David Zervos on, one of the potential candidates for Fed chair, who said the Fed should cut 50 and they're leaving millions of jobs on the table. That's Zervos' point of view.
Yeah, Steve, thank you very much.
Pleasure.
Steve,
See, the thing you got to do here is you have to. One, the Fed needs to lower interest rate. The 10-year yield, okay? I'm looking at the 10-year yield here because that drives a lot of the loan activity you'll see out there, mortgage rates, things like that. A lot of it's driven by the 10-year Treasury, okay? And so the ideal situation would be the Fed is lowering rates, but simultaneously you have investors not being that concerned about inflation. The issue you could run into is, let's say the Federal Reserve does start to lower September, but let's say investors are very concerned that inflation is going to remain much higher, then what could transpire is a 10-year yield could actually basically go up. It could also hit like 4.5 or 4.6% or something like that, which is the opposite of what Trump wants right now, and really even the Fed wants. And the reason that could happen is if the Fed's lowering interest rates and people become, let's call it, less worried about recession, but more worried about inflation. So, I mean, that's just something to kind of factor in here, but there's a lot of moving parts, and we'll see how it all shakes out. At the end of the day, you just got to remain focused on the long term as an investor in the market, right? All this stuff is going to be like all this talk about rate cuts, this, rate cuts, that. When are they going to cut? September, December, next year, blah, blah, blah. 5 years from now, it's going to be irrelevant. It's just going to have been part on the scale, right? And so, like, you can't get all freaked out and crazy about these sorts of things because it just is what it is, right? Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. Once again, if you want my stock picking checklist for free, pinned comment down there. You can click on that, put in your name. We can send it over via email or via text, whatever's easiest for you to get access to that document. And I think you guys will definitely enjoy that. Much love and have a great day.